Hello and welcome back. Toot is a brilliant, seasoned manager that is running the largest startup ecosystem in Israel. And we're going to be talking about everything business capital. It's a really fascinating overview of the history of business capital, together with the different channels in which you can get money for your business. And also, even we're going to talk a little bit about how investors invest into these different buckets of money. So if business capital is anything you're interested in, this is an amazing episode you should not miss. Brilliant.
So back in the 1970s, there was a new structure that was formed. It was called venture capital. So before that, as a business owner, as an entrepreneur, you had to just build a business, find customers, get your customers in, put every month or every quarter 30% of the margin aside to reinvest in the business, and then you grow. But you grow only in the pace of your 30% margin that you can reinvest. You cannot grow faster. So you had family businesses that are being, established, like retail and apparel and manufacturing and many old-fashioned traditional industries that were founded in the last century because they were founded by an independent capital. And what happened in the 1970s is that a new structure was formed, a structure that was said, hey, I would be a financier. I am an individual who knows how to manage capital. And instead of being a bank and giving a loan that the entrepreneur, the business owner needs to give back on a monthly basis or a quarterly basis, and what you get as the financier is the interest of the loan. This is your upside. There were a new generation of financiers who came and said, I don't want to get the interest of the loan. This is not interesting enough for me as an investor, as a financial person. What I want is a cut of the success of the business. And that would mean equity, shares. They said, if I'm going to own 5% shares, 10%, 15% shares in Apple, and Apple makes it, I have very, very nice returns on my investment. And this is a new generation of financiers that evolved in the Silicon Valley back then, that wanted to leverage not the interest of a loan, but rather the success of the invested businesses. And that was called venture capital.
Let's talk about a few other aspects of how I can raise money other than VCs.
We have few types of financing sources. One is the people who love you, but not necessarily understand what you do, which is family and friends. The people who love being a part of the game sometimes understands what you do, but essentially would trust you as a person, which is angel investors. The people who are professionals in the game, but still have their own ways of selecting the startup company, the companies they invest in. They don't necessarily know what you do. They think they understand your market, and they usually would invest because they believe you would be the winning player in the game you are trying to compete, which is venture capital that we just spoke about. On this side of the table, we also have crowdfunding, which is the same. You sell thin air, you sell a vision, you sell a story, you have a video. The more compelling the video, the more emotional the video, the more convincing you are with your story, the more likely you are to get the dentist from Denver to give you $100,000 or even $50, because that's what crowdfunding is all about. We also have family offices. Now, family offices is actually somewhere in between because when they do invest directly, which is not happening very often, they would invest in you as a person. They don't have a lot of experience investing directly in startup companies because those family offices are exactly those individuals, those entrepreneurs we spoke about before. They are the entrepreneurs who didn't have access to external capital. They built a business by themselves. They are business people. They have a lot of money, but they don't understand fast-growing companies. They would kind of invest in you as a person, but on the other hand, they are business people that are driven by, balance sheets and P&Ls and performance. So they would lean also on the other side where they need to see what you do, how you do it, and how it performs. So they are kind of the linking piece between the thin air and show me the magic. So on the magic side, you have banks, which always they were there, they stay there, they are very happy to give you loans. Then you have a new type of financing that is really new. I think it's the newest of all the areas that we speak about, which is revenue-based financing. They like companies that are SaaS-based. Why do they like SaaS-based? Because SaaS-based is predictable. And when you have a company that already generates $5 million annually in ARR, and they can show a track record of, let's say, 20% month-over-month growth, you can predict the revenue in the coming years, year or two. And what they say, those revenue-based financing, they say, I don't want equity in your company. I want you to color a portion of your future revenues for me. And they give you money based on future revenues.
The earlier the stage is and the smaller the amounts are, it's a lot more emotional than it is fact-based.
Yeah.
Right? If you're looking to family or friends, you're looking at angel investors, they're going to invest in you. And then the emotions play a very big role. And crowdfunding is the same way, mostly because it's just you talking to a person, not necessarily a person that has any clue about what you do. And the deeper you go and the bigger the amounts get, it becomes less and less about the emotional aspect, more and more about the performance you can actually prove that you can generate. And again, you touched on a very interesting point. In this last example, it's not even the performance, it's the fit. Like if you can sell the future better state to the corporation because of what you're doing, that's where now I'm going to go back to my terminology, that's where the magic happens. You don't necessarily have to have it working right now, but if you can fulfill your promise, it will help the organization solve a big problem or do something that they cannot do right now.
But this makes sense because if you think about it, I mean, when you're speaking with a kindergarten kid, 99% of them would be cute. Like you would love them, regardless of what they say, who they are they mean? If they're mean, it's cute. But when you're going and speaking with an adult, you would not judge them only by their, pure of heart. You would also consider their experience and their manners and their, position in life, their socioeconomic situation.
Sure.
You're evaluating them in a different scale. So it's the same. It's a very defined game. And VCs, for instance, are looking for something very particular. Because imagine those VCs that are looking for sometimes 3,000 ventures a year, and they would invest in how many? 10, 15, 30, 40 maximum. So they need to have their mechanism of de-risking. So if your end goal is to get a tier one VC to invest in you, or to go at to reach $1 billion valuation, you need to gather in your cap table, to gather in your capital, the right people in the right time. And this process usually would go through family and friends. So first of all, you put your own money and you convince your uncle and neighbor to give you some money. Then you work a bit, you build a bit. Then you go to angel investors. While you are still in seed stage and you don't yet have the magic performance to show, you still need to prove it. You need to do a pilot testing, you need to launch, you need to do some A/B testing, to do tweaking on your product. So it is still about the product development and not the market or the business development. You would go to angel investors because they would believe in you as a person and the fit between you as a person to the project you're trying to build. Those angel investors would usually give you a checks of between, I would say, $10,000 to $250,000. Majority of them, you have some super angel investors that can also write you $500 or $1 million checks, but majority are in the lower ranges. Then you get your seed money, which usually would be, under 5 million, up to $5 million at once or in chunks. And then once you rolled out your solution, you have some market proof. You showed that someone wants to buy what you do. You need to go to VCs. You need to show some consistency, something that the VC would say, okay, it is not as risky as going into just a product that wasn't enrolled in the market yet.
Yeah.
Then you go into the VCs, and the VCs would give you checks of between 1 million to, let's say, 10, 15 in this A round financing. And from that moment on, given that you're actually doing a good job and you didn't completely, burnt out the $10 million of that VC, you actually get to a point where your company starts to grow. And once your company starts to grow and starts to perform, you can unlock the other sources of financing as well. So corporate VCs would enter into the game, growth VCs would enter into the game, revenue-based financing, if you are a SaaS company, can enter into the game. So that's the monopoly game. This is the board game we're playing in the VC world. If you do have the capital and you don't want to work in this full time, you just want your capital to work in this. B, you don't want so much capital to be drawn into several companies. You want a bigger diversification to your investment. And C, you want a professional to do that for you, to manage your capital for you.
Yeah.
If you actually want this capital to give you returns, and it's not only a matter of educating yourself or doing some entertainment for yourself, like having fun, it is better to go to a VC because you know that your money is safe. You have still the community because you have the community of LPs that are invested in the fund, and you have a trusted advisor, which is the fund manager, which, trust me, if you would ask them on a specific startup that you would like to invest in, either the fund would take over and would say, wow, this is actually interesting, and you have a much higher qualification. You can always invest on top if you want to invest individually. It's not mutually exclusive. And as well, you have the diversification because a fund doesn't invest only in 1 to 5 companies. They usually invest in 20, 30, 40 portfolio companies, and the ability of the fund as a structure to support the portfolio growth is much larger than you as an individual. Doesn't matter how successful you were because you're only one. And the fund is normally several people, and this is their job. This is what they do. They sit with the entrepreneur, they sit with the company, they navigate the strategy, they provide resources, they support business development, they support the recruiting, and the likelihood of those startups to actually work and succeed is much higher than if you go and you bet on the person, which, as we said, because as an angel investor, you would not have the companies that are mature. You would usually have companies that are very early stage, so the risk is higher. If you want to make your money make more money, VC is a better choice. If you're an angel investor, you can either go yourself, put on LinkedIn, angel investor, immediately, trust me, you would have 100 approaches a day. Not always good companies, but you would have those 100. You would feel like you're in the game. You have some deal flow. You feel like you're meeting entrepreneurs. So it would be entertaining. Not sure if it would be profitable, but entertaining it would be. And invest yourself, individually. You would negotiate yourself with a startup. You would put your own capital and try to help them probably as much as you can, which could be a full-time job. If you invest as an angel investor in 20 companies, trust me, it's a full-time job.
Yeah, I'm doing it today with very few companies, and it's A, fascinating. B, the only way I do this is when I directly mentor the CEO, because that allows me to help the company grow. And obviously, I only do this in places where I think I can provide value and the companies are worth investing in, but it's time consuming because you need to do the research. Again, you don't have to, but the way I do this, I want to be involved in what's happening in the company so I can increase the chances of getting my money back tenfold, right? Versus just throwing the money somewhere. So it's a very fun game to play if you enjoy the business world, but you have a lot of eggs in very few baskets, which is a disadvantage.
And this is why it's very risky. You do have today some angel clubs. They don't do the diligence for you necessarily, and they don't take responsibility on your investment, and they don't manage the portfolio. You're on your own. But they do their best to bring the deal flow. They do their best to vet the companies. You also have the effect of the crowd. If you are 50 angels in the club and 30 wants to invest in a given company, you kind of maybe think that they could be good, even though it's not always true. Sometimes an entrepreneur does a very good show and a very good pitch, and they don't know how to execute. But it is kind of, giving a social element to angel investing.
What's an average minimum amount that a VC would take that you need to put in order to be a part of a venture capital fund? Same kind of question for a family office to be worthwhile for them to manage your money. And angel, obviously, it depending on what the startup will take, right? Some startups will, like you said, will take $10,000. Some will say minimum investment is 50, but that's usually the range in the minimum. So I know that one. So I'm asking about the VC and family offices. How much money do you need to put in, let's say, one of them in order for them to even allow you to play their game?
It depends on the size of the VC, usually. So the big VCs are approaching institutional investors.
Got it.
Or family offices that can invest a minimum ticket of 1 or even 5. VCs that are $100 or $300 million fund, they would not go about and take angel investors of $500,000. They would go to institutionals and take checks of 10 as a minimum, 10, 20. But smaller VCs, where these are majority of the VCs in the world, these are VCs of, I would say, between 15 to 100. And many times they are open to private investors. And in those VCs, you can usually invest as low as $150, $200, $250,000. So it is kind of equivalent to an angel investing. But you gain more diversity and you gain less risk. And that's on the VCs. And family offices usually have larger capital managed, and therefore they want to deploy a higher amount. So giving $250 wouldn't move their needle. It's like crowdfunding for, individuals. You put $500, you have 10x, then you have $5,000 back. It's not very attractive. So this is for the family offices. And wealth managers would ask for even higher amounts. So they wouldn't speak with an investor with less than, $5 million in managed assets that you would give them to deploy.